Hello everyone and welcome back to another video. Again, glad you are joining me. If you enjoyed this one, please consider hitting the like button and subscribing if you want to. I put out videos on Mondays, Wednesdays and Fridays at 2 p.m. EDT or 8 p.m. CEST, so stay tuned for that. As always, you can drop me any questions whatsoever in the comment section and timestamps will be in the video description. Let's get going. Buying the dip is the idea and a strategy of waiting for a significant pullback in share prices before buying. Many investors subscribe to this approach and swears to the good old saying, buy low and sell high. Now, I personally never wait for any particular price level before buying, as I'm a long-term investor who's planning to hold on for the long term. But for curiosity's sake, I wanted to figure out how the two approaches stack up against each other over time. To illustrate this, let's use an example of two investors. Investor A puts $10,000 to work in an S&P 500 index fund in December of 1990. Investor B instead waits for a 10% correction in the market before buying. But when she does, she puts $3,000 to work. So I think this is a fair comparison. Now, investor B will time the bottom of every dip perfectly down to the day, while investor A will simply let the money work over time. Now, I'm sure I'll mess up some numbers here, so bear with me. Dividend will be added, but only be roughly calculated and accurate down to the month of the actual dip. And I'm using an S&P 500 return calculator for this video, which is a great source for anyone looking to play around with potential returns of the stock market, by the way. Now, I'll start off with investor B just to keep things interesting. So we had 7 drops of 10% or more. Most of them were random corrections, but of course we had the dot-com bubble in 2002, financial crisis in 2009, and the pandemic in 2020. And overall, by putting $3,000 to work on the exact day each dip bottom, investor B was left with $51,324. And with dividend, she was left with roughly $72,071. Now, investor A, this is a simple one, was left with $100,250 without dividend and $195,200 with dividend. So without dividend, investor A came out on top with 95% more, and with dividend, he came out with 171% more. So even if investor B invested 2.1 times as much as investor A and timed every dip perfectly down to the day, it's not even close. And keep in mind, this period also presented some of the greatest buying opportunities in history and contained 3 major market-wide crashes of 30% or more, which doesn't come by very often. Investor B would have had to invest $8,000 each dip in order to catch up, meaning she would have to invest 5.6 times as much as investor A. If nothing else, I hope this example and this video serves as yet another example and reminder of why waiting for a dip in the market or in any specific stock is a loser's game. It is mathematically, statistically, and probabilistically inferior to lump sum investing. And dollar cost averaging doesn't fare much better, in fact, and has been debunked by every study conducted on its effectiveness. Now, before I go on, I have to bring up a, not question, but comment of the day, and it comes from John Smith. I find your content very boring but factual. For that reason, I will continue to watch your dull videos. Good luck for 2021, young man. Well, thank you so much, John. My videos are boring and they are dull, and it's for good reason. I think they're different from all other financial videos on YouTube that are just trying to be over dramatic and exciting. I will try to make my videos a little bit quicker and a little bit more interesting over time, but for now I'm happy keeping them factual and dull, but hopefully not as dull as they have been. So thanks so much for the comment, John. I appreciate your sincereness, and I will take it to heart, and hopefully my videos will be improving over the course of this year. You can always make the case for waiting for dips in like high-flying growth stocks or reserving a small amount of cash just in case of a collapse in prices, but it doesn't change the statistics. So it's important to keep your emotions out of investing as much as possible and let reason take the wheel. And what confuses a lot of investors is that when they look at a chart, they see these huge drops and they think that's when you should buy. In reality though, the bottom of most crashes isn't any lower than the prices were 1 or 2 years prior. So you end up sitting on the sidelines waiting while prices go up and you're waiting for a dip. But the dip isn't big enough to make up for the gains you lost while waiting for it. Besides, no one is able to predict the bottom or top of any market ever. And if anyone could, we would have heard about them by now. On top of this, most bear markets come after bull markets, so prices have most likely been going up a lot previous to the drop, meaning investors might be still well off after the drop. Additionally, the market usually corrects itself within 2 to 3 years. In 2020, it corrected with it in no time, just 3 to 4 months. And then the market usually starts a new bull market which makes up for the losses in no time. The age-old saying of buy low and sell high isn't really meant as a strategy, but rather describes the concept of investing. You buy an asset for a price and then you sell it at a higher price, leaving you with a profit. But this goes without saying. It does not mean you should wait for a dip in prices before investing, as doing so will lead to more of a almost never buy and make less money, or buy high and sell higher kind of scenario. Now, I've personally jumped with both feet into stocks and Bitcoin at all-time highs, and I know the feeling of thinking you got in at the top. But if you look at charts of most companies, however, you can see that the share price has been at all-time highs for years. So just because the price is at an all-time high doesn't mean it can't go any higher. And remember that share prices are relative to the underlying company. And if we take 2 examples, with the exception of the 2020 crash caused by the pandemic, Amazon and Apple, for example, have been at all-time highs pretty much for a decade. So what would happen if you waited for a dip in those stocks? You would have never invested. And as an ending, I want to know, have you ever been caught waiting too long for a dip, or have you ever timed one perfectly? Let me know in the comment section. And of course, I know many of you believe in buying the dip and are usually skeptical of any bull market or optimism. But I urge you to come to terms with the reality of numbers and put your emotions aside sometimes. You know, every once in a while you might be right, but most of the time you won't, no matter who you are. And although a healthy level of skepticism is never a bad thing, I would personally reserve it for the most extreme cases when a stock is up hundreds and hundreds of % in less than a year. So that's it for this video. I think it was a pretty cool example. I'm pretty sure I got the numbers right. I was a bit surprised at how poorly the buy the investor B performed over the years. And of course, dividend just adds even more outperformance on top. So I hope you enjoy this one. Give me suggestions for topics for future video, guys. I always need more input. As always, thanks for watching. I hope I'll see you in my next video. And remember to take care of yourself and your loved ones. Have a good one.